Morning, everyone. My name is Philipp, and I'm one of the fund specialists at PSG Asset Management. I'd like to welcome you to our winter update today, in which we will be talking about equity markets, both global and domestic. Our speakers today will be Shaun Roux and Philipp Wörz. Shaun has been managing the PSG Equity Fund for almost 20 years and is also responsible for the PSG Flexible Fund. Philipp has been at PSG for 15 years and is a fund manager on the PSG Global Equity as well as the Global Flexible Funds. They both serve on the Equity Investment Committee at PSG Asset Management. In terms of today's agenda, we are going to be talking about the equity markets, as mentioned. Shaun will start by discussing the market conditions and what clients should be looking out for. Philipp will address some specific factors that are having a big influence on markets as well as our portfolios, things such as resources, ESG, and market structure. He will show why these have given rise to an amazing opportunity for differentiated global investing. Shaun will consider these as well as domestic factors and how they impact our local portfolios. Both Philipp and Shaun will offer some guidance on why we are so excited about the returns embedded within our portfolios. I'd also just like to mention that we have applied for CPD accreditation for this event today. Without further ado, I'd like to hand over to Shaun Roux.
Good morning, everyone. Thank you very much for taking the time to join us today. It's a great honor to be talking to you, and we will be unpacking equity markets and what that means for our portfolios. And I remind you that all of the PSG funds shop from the same buyer list, so the stocks we discuss today will be replicated across all of our funds. We like to start by trying to answer the questions that are top of mind for our clients. And we've polled our clients in this regard. And some of the questions that have come through that should be covered today are the social unrest that we've seen in South Africa and what that means for domestic investments, the recent rout in Chinese internet stocks, and in particular on the domestic front, Naspers, and what we think about that. We'll talk about ESG, which is very topical. We're getting a lot of questions around cash levels in our funds. They're low at the moment, and we'll talk about why that is. And we'll spend quite a bit of time unpacking just why we're confident on the stocks that are in our portfolios. Turning to the market conditions, the message from ourselves is that we are dealing with challenging and very extreme markets. And the first aspect we'd like to draw attention to is something that we're all very familiar with, and that is the incredibly fragile domestic confidence. On the chart on the left, I show you business confidence, and during the course of last year, business confidence in this country plunged to the lowest levels in 40 years. We understand why confidence is low, but clearly COVID pushed us to extreme levels. Very low confidence always gives rise to cheap assets, and we're observing incredibly cheap assets in this country. And if you look at the bar graphs on the right, you will see that if you got your timing right and you were able to buy cheap South African assets at a time when confidence was at its lowest, subsequent returns were very good. And we show you there the 3-year returns for an SA Inc. basket, a local basket, and the returns for the all share. And we're talking 3-year returns here. So the extreme right part of that chart shows that if your timing was fabulous and you bought the bottom last year, you've already had very good returns. But when we look into our portfolios and we look at just how cheap some of these stocks are, we think good news lies ahead. Turning to global markets, I think there are a couple of observations. We think we're dealing with very extreme markets and in some cases, unprecedented conditions. This is a Bank of America chart that shows you that on this basis, interest rates are the lowest they've been in 5,000 years, which is absolutely extraordinary. If we think further about that, we currently find almost $17 trillion worth of bonds that are trading at negative yields. And if we look into those conditions, that would all be well and good, except for the fact that global debt levels have surged in recent times. Debt to GDP in the US has gone from 60% in 2005 to 130% currently. That's a consequence of the fiscal deficits that were run while central banks and governments around the world effectively responded to the COVID crisis. And in normal times, high levels of debt and low levels of interest rate just don't work, particularly when they're on the unprecedented nature that we find today. What we would like to highlight is that a normalization of this set of circumstances is going to be challenging, it's going to be noisy, and what we would be especially cautious of is owning assets that require interest rates to stay very low and inflation to stay very low, just to generate satisfactory returns. If we look into equity markets, starting with the US, there's no question that the US market is expensive. This chart shows you the forward price earnings ratio, in other words, the price relative to earnings that the companies are expected to deliver in 12 months' time. And looking at a market like the S&P, it's the most expensive it's been. The average stock is the most expensive it's been in many decades. If we look deeper into markets, you'll see that the gray shaded area on this chart, which demonstrates the dispersion between the cheap part of the market and the expensive part of the market, is as wide, if not wider, than it was during that dot-com era, those bubble conditions. This has a very, very important bearing on future returns from different stocks and different portfolios. If we compare different markets, the dark line at the top, which is the MSCI World Market, looking at it on the same basis, on a forward price earnings basis, you can see the influence from the US. You can see that that market has got significantly more expensive in recent times. If we look at emerging markets, they trade at a significant discount to developed markets, and particularly the US. But if we look at that thicker gold line at the bottom, which is the JSE All Share, you will see it trades, it has not only derated over a number of years, but it trades at a very wide discount to both emerging markets and in particular developed markets. And what we're observing here is we're looking at price earnings ratios of less than 10 for our market, which we think offers evidence of just how cheap South African assets are in comparative terms. In terms of dealing with these noisy, challenging markets, it's very easy to get emotional. It's very easy to get pulled in all sorts of directions. Thankfully, we've got a tried and tested process that we've applied for many years, and that's our 3M process that many of our clients will be very familiar with. What we are looking for is we're looking for underappreciated quality in the form of a moat or a good management team. But in particular, we want to buy those assets at a discount. And we're prepared to be patient. This is a process that has stood our clients in very good stead over long periods of time. The long-term track records of our funds are all excellent. But we keep telling clients that if you are looking for underappreciated quality, if you're shopping in out-of-favor areas, one of the consequences can be short-term underperformance. And this tends to happen when cheap stocks get cheaper. And if we want to look at how that process has worked in practice and what has happened in different periods. I show you here a chart of the PSG Equity Fund going back to 2002, which is when I started managing the fund. And what you will see is the fund has gone through tough times. It's not by design, it's more been a function of the fact that the market conditions have not been conducive to our way of investing. And those little red blocks that I show you there are the times where we have undergone underperformance. And the characteristics of each of those times is that cheap stocks were getting cheaper. And it's extraordinary if we actually look at those three periods, they all were very, very extreme periods. So in the early 2000s, we're just coming out of the Asian financial crisis. We had the dot-com blow-up. We were on the tail end of a very long bear market in commodities, and we had the 9/11 US recession, a really, really tough time on the local market, and stocks got really cheap here. We all know what the subsequent returns from the South African stock market were after 2003. The block in the middle, the GFC, we're very familiar with. Stocks got incredibly cheap. And then if we look at the more recent block, which speaks to 2018 to 2019, 2020, this is a period in which cheap stocks moved into a bear market, and most stocks in South Africa were in a bear market, and then COVID hit us. And COVID, as we all know, was an extreme event. What is important to note is that PSG, during those tough periods, did what our clients should expect from us. We were patient and we were brave where it was appropriate to be brave, and the subsequent outcomes were always good. And the chart at the bottom shows you the 3-year rolling returns that were earned, particularly after the tough periods. And you will see that we went into these multi-year, 20-year plus type return environments. If we look at today's market conditions, we conclude there's no reason that this time should be different. The question with respect to cash levels in our funds is one we field a lot. When markets are high, we unapologetically run with high levels of cash in our funds normally. But our clients don't own the market. They don't own those popular stocks that are dominating the indices and dominating the portfolios across the board. They own a different cohort of stocks. And last night we saw the S&P and NASDAQ hitting all-time highs, the JSE, all shares not far from all-time highs. But here I show you the highest conviction holdings of the PSG Equity Fund. These are the domestic holdings, and the number there represents the upside if the stocks that our clients own were to reach all-time highs. And so if Anheuser-Busch went back to highs, the stock would double, JSE pretty much the same, etc., etc. So the key point to be made here is that there's a tale of two markets. You have expensive, popular, well-owned stocks, and then you have stocks that are just coming out of that bear market where we see significant upside. And we refer to them as the winners of the future, as opposed to the stocks that dominate most portfolios out there, which are the winners of the past. Exactly the same situation is replicated in our global portfolios. These are the top 10 holdings of the PSG Global Equity Fund, and as you'll see, there's significant upside embedded in those stocks as well. At this point, I'm going to hand over to Philipp, and Philipp will be talking about some very important factors at play with respect to global stocks and what that means for our portfolios.
Thank you, Shaun. Good morning, everyone, and thanks very much for joining us today. My name is Philipp, and as Greg reminded me earlier, I've been at PSG for a long time. I'm now going to take you through some specific macro themes that we think are giving rise to fantastic bottom-up opportunities for differentiated investing. As you would know, the price of copper has doubled since last year. Oil prices are back around $70 a barrel, and even thermal coal has tripled since September of last year. We are currently in the second bull market in commodities in the last 15 years. And as you can see in this chart here, this is the Commodity Research Bureau's index of commodities. We're at levels last seen in 2011. Now, back in 2006, 2007, China gave rise to a super cycle, and prices stayed high for a long period of time. The proponents of the super cycle today would point to the lack of new supply to meet the strong demand required for metals, for global decarbonization, and from strong infrastructure spending to stimulate economies. Now, the issue we're seeing in commodities generally, when times are good, memories become short, and people tend to lose sight of the fact that commodities move in boom and bust cycles. And herewith, it's worth remembering the vicious bear markets that we saw in 2008, 2009, and 2012 to 2016. Now, the reason markets move in such sharp cycles are the discrepancies between demand and supply. When prices are strong, when demand is strong, miners are incentivized to increase production. But the issue is, it takes a long time to add the supply. Now, on this chart, you can see this is the large global mining companies, the BHPs, the Anglos of the world, and they responded to the strong demand out of China, and capital spending went from $17 billion to over $75 billion within 7 years. BHP Billiton, for example, their surge in capex from $6 billion to $23 billion was a poster child of what went on at the point in time. Now, that rush to really add mining capacity at a time of high prices ended up flooding the market from 2012 to 2015. Now, that coupled with its slowdown that we saw in China at the point in time caused commodity prices to drop. Now, those miners, like a Glencore or Anglo, that took on debt to fund expansion, found themselves in trouble. Their balance sheets got obliterated, and share prices got not wiped out, but almost wiped out at the point in time. While this is pretty difficult to imagine today, given the strong environment, I'll take you back to September 2015, when Glencore had to do an emergency capital raise. You would probably recall Anglo American at the time was downsizing. They were busy selling a lot of their assets at the low points in the cycle. And I could probably carry on for hours, but we saw similar experiences in the global shipping industry. One of the world's top 10 container shipping companies, Hanjin Shipping, went bankrupt in 2017. The oil industry, when oil prices crashed in 2014, and even last year when they went to negative levels. Now, why am I saying this? These experiences of these companies had a profound impact on subsequent investor psychology. Instead of growth, people started demanding, well, first of all, balance sheet restoration, capital preservation, and then returning cash to shareholders. And that mantra carries forward to today. Now, this near-death experience that we saw in the industry and new shareholder demands for discipline saw industry capex come but all to a halt. On this chart here, you can see the capex spend that I showed you earlier after 2012, and industry capex reduced to under $30 billion by last year. And those $30 billion are mainly just to replace operations. Now, the big question we're facing today, and that's pretty much the unknown, is what's going to happen to supply going forward, given the strong demand narrative currently out there. The message that we are getting from mining companies, and I actually met with Glencore, for example, yesterday afternoon, but the message we're getting is that prices would have to stay at sustainably high levels for a long time to bring on new capacity. And even if mining houses do start pushing the button again, I just want to remind you that for commodities like copper, it probably takes between 8 to 12 years to bring on a large copper project from scratch. Now, while we do expect in copper, we do expect some capacity to come on in the next 2 years, the current projects in the pipeline are 60% below where they were in 2008. The reality is the industry isn't spending enough, and coupled with strong demand, prices will stay high for quite some time if you're looking over the long term. Now, from a demand perspective, we obviously looking at different commodities at PSG, and our preference is to invest into those commodities where we are seeing the stronger demand supply fundamentals. And here would contrast our preference of a copper commodity over iron ore, for example. And we're seeing similar dynamics in the oil industry. You would remember cheap capital and fracking allowed a wall of production to be added between 2010 and 2014. The resultant oil price crash that you can see here ultimately caused an increase in the cost of capital and a large decline in capital spending by the industry. Now, despite oil prices recovering back in 2018 and also more recently, the oil industry isn't responding to these higher prices, and that's largely due to shareholder-imposed discipline. And by the way, we're also seeing OPEC behaving a lot more responsibly versus history. Now, we can't really talk commodities and energy without discussing ESG. In commodities, historically, high prices are usually the cure for high prices. But ESG seems to have upset this dynamic somewhat. While globally, the ESG revolution is evolving and the objectives are sound, the current focus is firmly on the environment. And besides discipline at the company level, we think ESG is contributing to the supply and demand imbalances that we're currently seeing. As I mentioned, the focus is currently strongly on the environment, but what we're currently observing is a lot of pressure imposed by governments and activist investors that are putting out targets for greenhouse gas emission reductions and carbon reductions. While I think these steps are certainly well intended and a more proactive response to the environment is long overdue, the issue is far from simple, and the solution is even harder, to be honest. But in our view, though, the risks of unintended consequences are extremely high. If you look at even at optimistic projections to the global energy transition, it will still take decades for the globe to rid itself of fossil fuels. And by simply placing a moratorium on oil production, for example, is simply going to lead to shortfalls and higher prices. Now, higher prices will ultimately incentivize a faster transition to greener energies, but there are also a tax onto consumers and poorer countries specifically. From a demand side, the strong targets for carbon reduction will require the aggressive rollout of renewables capacity and adoption of electric vehicles. This transition is of huge scale in our view and will require a lot of quantities of greener metals such as copper, cobalt, nickel, lithium, graphite. I could carry on. Now, to us, it's fascinating to observe some of the solutions that various think tanks or authorities come up with to get to carbon neutrality. I'll just give you an example to just give you a flavor of how this ESG revolution is kind of evolving. This is UK government-sponsored research where they asked researchers at the University of Cambridge to come up with solutions to get to net zero by 2050. And while I'm not joking, the recommendations were to close all airports in the UK, to close all shipping, and to ultimately phase out all beef and all lamb. Now, while that's quite a noble endeavor, I want to make 2 points. I don't think I'll be moving to the UK, and I think at PSG we want to look at ESG in a more pragmatic fashion. Now, those of you that know us, you probably wouldn't be surprised that we are looking at ESG in a slightly different way. We obviously take ESG very seriously. We are signatories to the United Nations Principles of Responsible Investment, and those carry their own set of responsibilities. But we also like to invert on things at PSG, and you probably will agree with me that ESG, how it currently stands, can also be used as a great source of opportunities for investment. ESG is integrated into our process, but it's really been, to be honest, relatively easy from the perspective we've always had a strong focus on sustainability and governance, given our focus on moat and management. But we think ESG really provides us with 3 distinct advantages. First one being having ESG integrated into our process, we're looking at companies specifically through the ESG, through the risk lens about companies. Secondly, ESG is really a tool to help us improve our interactions with companies and management teams, and it helps improve governance of these companies. And I refer you to the annual stewardship report, which is on our website, to give you some examples of that. And thirdly, very importantly, ESG can be used as a great source of opportunities at alpha creation, as investing into companies with poor ESG perceptions that are subsequently improving can be pretty fruitful. Now, that's our approach. Other companies do it differently. I'll give you an example. Many asset managers would look at ESG and decide just to divest from companies that are involved in fossil fuels. Or they might push those companies to dispose of assets that are engaged in environmentally unfriendly activities. We think that doesn't really solve the problem, and in some cases actually makes emissions worse. If you, for example, force a company to sell their coal assets to a private player, or a private player that's in less environmentally responsible jurisdictions, that company will probably be doing worse for the environment going forward. Similarly, if you unbundle a company, all of a sudden that company has separate shareholders to answer to, ultimately making emissions worse. So we keep an open approach to ESG. We are open to investing into companies where there is an ESG-related discount, and we can rather be part of the solution of going forward. And we think that approach is better for the environment ultimately, but also for our investors. Now, having covered the commodity environment we're currently seeing and some of the ESG angles, I'm now going to give you two company examples, the first one being Rolled Out Shell and then Glencore, of how they fit into our ESG and commodity lens. As Shaun said earlier, we are looking to invest into companies that are underappreciated from a quality perspective, but are trading at cheap valuations. We think Shell ticks the boxes on this front. As you will probably know, Shell has been in the crosshairs in the last couple of years by ESG activists and hostile governments, and they've had significant pressure put on them to reduce their carbon emissions and accelerate the transition to cleaner energies. Now, that pressure had happened to coincide with the COVID crisis last year. This crisis ultimately caused the biggest oil demand shock in non-war times. The company has also been hated by income investors, those investors that buy Shell for the reliable dividend. Last year's issues caused Shell to cut the dividend for the first time since World War II. Now, while these are all kind of true, what we think these narratives underappreciate are the qualities that are inherent in Shell's portfolio. I'm now just going to give you a brief flavor of what we are buying with Shell and why we think it's a good opportunity. First off, on the left-hand side, Shell has got an incredible marketing business where they've got an unparalleled footprint of service stations. They've got 46,000 points of presence around the world. That's more locations than a Starbucks or a McDonald's. And this is meant to grow to 55,000 points of presence by 2025. We think this business underpins value for Shell almost regardless of the oil price environment. Part of the integrated gas business, Shell has managed to build up the largest global LNG, that's liquid natural gas business, with a 20% market share. LNG is a critical transition fuel and a source of energy for those countries that are trying to move away from coal but don't have their own gas reserves. The LNG market is meant to grow at 4% per annum until 2040, and Shell has incredible competitive advantages. They've also managed to supply LNG in a carbon-neutral manner where they're able to command premium pricing. Additionally, in Shell, we're buying a chemicals business. This chemicals business focuses on low-carbon, sustainable chemicals. While it's smaller in the mix, it's an excellent business. We take up some debt and central costs, and we get to about $150 billion. That happens to be the same as today's share price. Now, what we're buying with Shell, we are not paying for the oil business at that valuation. We're getting all the upstream assets, the traditional oil and refining assets, for free. These are assets that, at $65 oil, generate $10 billion of free cash flow per year. And the low-cost assets, they break even at $30. Now, we think the strong cash generation coming out of this business and Shell's other businesses will not only allow Shell to pay strong returns to shareholders, but also fund an accelerated transition to cleaner energies. as Shell, as they have committed to run down the oil business over the long term, and as they grow into cleaner energies, we think Shell will become part of the solution to the green revolution. And by doing that, improve the perception in the eyes of ESG investors. Now, that improved perception and the strong dividends and buybacks coming out of Shell will, in our view, close that large gap to intrinsic value that we are seeing. And we think last week's step of increasing the dividend 34% is a step in the right direction. Another good example that fits into this ESG and commodity lens is a company called Glencore. You'll all be familiar with the company. But Glencore really, they are one of the largest low-cost producers of the green metals required for the energy transitions, such as copper, nickel, and cobalt. Differently to their peers, such as Anglo American or BHP, they've decided to hold onto their coal business and run the business down responsibly in line with long-term demand trends. We think this is the right strategy, given this business, firstly, is held in responsible hands, but also it will most likely generate a lot of cash for shareholders, given the lack of supply that we are seeing in the industry. And also, I think they're using ESG to their advantage. And while shareholders might have forced Anglo or Billiton to dispose of coal assets, if you look at a recent deal Glencore did, where they bought out their partners in the Colombian joint venture, they were able to buy that asset at a payback period of about 1.5 years. We also think Glencore is well positioned on the supply side. And here we would contrast the company over the iron ore peers. But where we really found Glencore interesting is Glencore, because of their regulatory investigations, has been trading at a big discount more recently. But the company has taken, in our view, the right steps to improve that. They've improved governance, they've changed management, and from a climate perspective, they've committed to get to net zero by 2050, and also recently increased their medium-term commitment significantly. Now, on the management team, you may ask, we obviously like management teams with large shareholding. Ivan Glasenberg retired at the end of June. He owns almost 10% of the company. The new management team, while they're certainly not of Ivan's wealth, they've got significant wealth tied up in Glencore in their own names. And given the mantra of capital discipline, we've got strong confidence that mantra will continue going forward. Now, while the stock has done well in the last kind of 6 to 8 months, we think the cash generation that will increasingly be given back to shareholders and quality of assets means the company is still a great investment today, and we still find a wide margin of safety in Glencore. I think one of the questions that's come up quite a bit before doing this presentation today has been our view on global inflation. Now, while the ESG environment that we kind of are painting here looks highly inflationary to us, and also the lack of supply in the industry, it's really a topic that there are also many reasons why inflation is transitory, and we could probably be here all day without coming to an answer. So let's leave that for another day. But I think if you may ask, what's inflation got to do with market structure? And Shaun referred to this earlier. When we're looking at positioning today, the market and passive strategies are really positioned in long duration assets that require inflation to be transitory. And a lot of those assets are trading at expensive valuations. I'll point you to the S&P 500 here, where it's really fascinating for us that sectors that are not only cheap but benefit from would be great inflation hedges historically. Energy and materials are currently only just over 5% of the index. I think this chart changed since I updated it. But energy and materials jointly is currently 5.3%. I contrast this to tech sectors, and Apple, for example, is larger than the whole materials and energy sector combined. And you can see the other large names over here as well. Now, over the next few minutes before I hand back over to Shaun, I'm just now going to discuss what these factors that are discussed mean for a global differentiated portfolio, but also paint a picture of what differentiated investing can mean at inflection points in markets. Now, those that know us, you would know we are value investors to the extent we like to buy quality companies at a cheap price. But that value tilt that Shaun referred to has been a difficult period over the last few years. And you can see on this chart here, which is the MSCI World Growth versus the MSCI World Value Index, we've seen 13 years of value underperforming. So it's really been a painful period. And some of you may point to the recent value resurgence, but it's really been a drop in the ocean. You can see in the circle here, that's been the relative performance since the so-called value bounce. Now, the market conditions that Shaun referred to are extreme, and we think we are finding ourselves at potentially one of those inflection points. And to just illustrate what can happen at those inflection points and just illustrate the value that a differentiated portfolio can bring, I thought I'll zoom into the 2005 period, and see what happened then. In March 2000, if you wanted to generate positive returns over the medium term, you really had to be differentiated. What you can see on this chart here are the total returns over 5 years of some headline indices, such as the MSCI World, S&P 500, which lost 12% and 15% respectively. And you all know the tech bubble, how it burst. The NASDAQ 100 lost 2/3 of its value over a 5-year period. As I said, to generate positive returns, you needed to look different. I've given some examples here of a value-oriented index. For example, the Russell 1000 returned 30%. MSCI World Materials and MSCI World Energy gave you roughly 60 and 70% in total returns. But if you're willing to invest into the cheapest assets at the time, as I mentioned, the MSCI World lost 12%. If you invested into the 20% of the cheapest assets on a price to earnings and price to book ratio at the time, you actually generated 150% over the subsequent 5 years, which is not bad on the down market. Now, to give you a flavor of what value investing means for us and what a differentiated portfolio looks like, I've brought up our top global holdings on this slide. We're currently very excited in that our buy lists are full and we're finding good opportunities in really diverse areas. What these companies here have in common, if you had to look at one common thread, is that they all have inherent qualities, they offer inflation protection, and they're all trading at a discount. And if I want to make one point on this slide here, is value investing doesn't mean you have to buy junk. And the real beauty of the extreme environment that we've seen recently is that we can buy good quality companies at cheap prices. If you're looking into the box on the left, we would categorize those as high quality defensive companies. These are companies that have outperformed the market over the long term, but because of temporary issues are currently trading at a large discount. One good example would be Anheuser-Busch, a large holding across all our funds. The company is the world's largest brewer with 7 of the top world's 10 brands in its portfolio. They've got an excellent long-term track record, and given its exposure to emerging markets and demographically advantaged emerging markets, the long-term growth prospects are also very, very promising. But because of issues such as COVID and lockdowns and certain input cost pressures, the company is currently generating low earnings and is trading at a low valuation. In the box on the right are companies that also have inherent qualities but are more cyclical by nature. I referred to Shell earlier, I talked about Glencore. We're seeing similar opportunities in other oil companies and in shipping companies, chemicals, fertilizers, the list goes on. We're also still seeing great opportunities in Japanese financials. Not only are these companies cheap, these companies, Resona and Japan Post Insurance, we think are providing good downside protection at a 5% dividend yield, are growing businesses, but offer proper upside leverage to any change in the status quo on interest rates. So I hope, as I've been able to demonstrate, we are different to many other portfolios you probably look at. And these companies, as I'm sure you agree, haven't benefited from passive flows or require rates to stay low forever. Now, we don't generally want to talk about short-term performance too much, but I think it is important to also point out sometimes that a differentiated portfolio can perform well. And when we're looking under the bonnet of our funds today, we've got strong confidence that that can continue going forward. So thank you for your attention, and I'll hand back over to Shaun.
I'm now going to turn to the local market. I'm going to talk a little bit about what some of those themes that Philipp spoke about mean for our local portfolios. I'm also going to talk about the stocks we own and why we think those could be some of the winners of the future. If we look into that theme of very strong supply fundamentals for a number of commodities, which is the way that we choose to look at more cyclical businesses, much more focused on the supply side than trying to predict where demand might be at some point in the future. The last little while has been quite fertile in terms of giving rise to some very good ideas. And in particular, the COVID panic of last year where everything went on sale. And the consequence of that is that commodity-related exposure in our funds has increased over the last 18 months or so, to the extent that if we look into the PSG equity fund today, almost 30% of the fund is in commodity-related stocks. We're shopping from both our domestic and global buy lists. I remind you that PSG runs a global process. Our local funds get the opportunity to shop from very good global ideas. So you will see across our local funds, you'll see the likes of a Shell or a Wheaton becoming quite significant holdings here. I think importantly, we don't think one just invests in commodities on a blanket fashion. We invest in a bottom-up fashion, so it is orientated towards specific commodities, and in particular, specific companies. And what we're looking for is we're looking for companies where the supply side speaks to sustained and higher commodity prices. And in particular, we want to be buying the cash flows that are then generated at a wide discount. If you look into most South African portfolios, you're going to see heavy exposure to diversified miners and PGMs. We own Glencore Northern. We think they're great opportunities, but we think if you can cast your net a bit wider, there are even better opportunities. And I'll call out a company like AECI. It's a South African mid-cap, and mid-caps are, we refer to it as a sweet spot of our process. They're under-owned. They can't really do much for the portfolios of the very large asset managers out there, and they're incredibly cheap. So around 2/3 of AECI's profits are generated from their mining business in the form of explosives and chemicals. The outlook for that business is outstanding. The outlook for the rest of their businesses is very, very strong, and yet we can buy this business on 7 times earnings today. Why is AECI on a 7 PE? Because it's got the SA Inc. label. It's one of those deeply out of favor South African assets. Another differentiator in our portfolio is shipping companies. We have a preference for dry bulk companies. We identified the issues coming through on the supply side where no new ships were being built. Initially, we took pain on these positions in the likes of a Grindrock Shipping and a Star Bulk. And more recently, our investment thesis has started to play out. Those stocks have done well for our portfolios. But if we look into the structure of that particular market, we think there's still a long way to go. We expect exceptional cash returns from most of these companies over the course of the next few years. A very topical issue at the moment is Chinese internet stocks. Naspers is, up until recently, more than 20% of the local stock market, so it's obviously garnered a lot of attention, and as we know, it's very large across most portfolios. In fact, it's difficult to find a unit trust out there where Naspers isn't the number one position. This is not about crowing. We've made big mistakes in Naspers. We sold our Naspers way too early. But what I would like to talk to now is looking at Naspers, and in particular Tencent, through an ESG lens, and just to ask some questions. So if we look at Tencent, this is an immensely successful business. It's a fabulous business. We have a market structure where passive has come to dominate most of the money flow within markets, either direct passive or quasi-index tracking. And if you're a successful company, you're going to attract the money. And both Tencent and Naspers, up until recently, were top 5 stocks in the emerging market ETF, the MSCI ETF. So they attracting the passive flows, and then those passive flows are pushing prices up, which will then attract the momentum investors, which put prices up. But what Naspers has had, which is extra special, is it's had the discount. And that discount has been sufficient to attract the value managers as well, which is why one of the reasons that it's as well owned as it is in South Africa. Now, at PSG, Philipp spoke about our ESG process, and we've taken both Naspers and Tencent through our process. We've spent a lot of time looking at these companies. And when we concluded on Tencent, we concluded that there were significant risks, ESG-related risks, that weren't being captured by the share price. We concluded Tencent was investable, but we would require a far lower price to compensate us for those risks. What are those risks? Well, if we look at ESG and we think about the S and the G, if we look at the fact that Tencent is beholden to the Chinese government and the Chinese Communist Party, that means they're at the whim of the evolving policy with things with respect to capitalism and how that works, monopolies, where the social impacts of gaming, etc., etc. We also identified significant concerns with general corporate governance in China. We think the discount rate that we would apply to Chinese governments is far higher than it would be certainly to companies that we invested in on the Western side. But probably most importantly, we've spent a lot of time unpacking the ownership structure of Tencent through Naspers. And as many of you will be aware by now, there is a very tenuous ownership structure through the VIE. And what this means in practice is that your ownership is effectively cannot be held up in a court of law. We're not suggesting that the investment is going to be worthless, but what we are suggesting is that the price should be, from our perspective, should be a lot lower to compensate you for some of those risks. For us, a case of complacency with respect to local investors, a distorted market structure, and very much a selective application of ESG. We have no idea whether Naspers and Tencent have made a short-term bottom. We look into the markets and we can find far better opportunities for our clients currently. Turning to the domestic side, it's been a rough period for all of us. It's been a rough year and a half, and it's in particular been a rough month. Our thoughts go out to anyone that was directly impacted by the events that transpired in KZN and Gauteng a few weeks ago. For us, this feels very much like a case of 2 steps forward and 1 step back. And what I mean by that is we can observe some clear progress that's being made. We can see some very important reforms coming through, in most cases a bit slower than we would like, but we also keep getting setbacks and challenges. And the recent social unrest is a good example in COVID, clearly. I think we need to learn to live with social unrest. We're hoping that we've seen the worst of it in terms of just the scale of those events in Durban. But I do think we need to live with that. And I also think we need to be aware that behind the scenes, things are slowly moving in the right direction. And some of those moves have been masked by these very visceral emotional challenges that we face. In particular, I refer to the economic reforms that we've seen, some very encouraging developments in terms of power provision and at SAA and even at the ports. We've very focused on governance, and we also think it's appropriate to point out that there's improved governance. If we take the cabinet, yes, we've just had a reshuffle. Yes, if each of us were to pick the cabinet ministers, we might throw a few other names into the ring, but there are improvements taking place. This is an improvement, and I think more importantly, if you want to get depressed about the cabinet, go and look at the cabinet in 2017 when Malusi Gigaba was the finance minister. But importantly, we keep being asked this question, tell us about your SA Inc. investments. And we need to point out that we don't own a piece of paper called SA Inc. Our clients own businesses. Yes, the South African macro situation is relevant for a number of those businesses. A lot of them earn profits in areas outside of South Africa. But we're confident on those specific names. And why are we confident? These companies are resilient. They had a proper test during the course of last year. We expect very strong growth from here. And we expect it to be a multi-year story. We think the base is very low. Cash flow generation is excellent. Dividend yields are high. And when we compare those cash flows to the prices that we're paying currently, that margin of safety is very wide. Assets in South Africa are cheap. And typically, if you buy good assets at cheap prices, good things happen. A good example, and it sits squarely in our mid-cap sweet spot, is Imperial. We've been patient here, and you'll be aware that DP World recently has made a bid for this company, clearly recognizing the inherent quality of the assets that sit both in Europe and across the African continent. We think this is an opportunistic bid. The question that's pushed to us is, aren't you concerned that that everyone's going to take these JSE companies out on the cheap? We think that is a valid concern, and while the public markets are as depressed as they are, it is an opportunity for more opportunistic people in the private sector. There's a lot of money sloshing around in private equity and in private hands. They can borrow money really cheaply so they can get the paybacks to work very, very quickly. We can sit and be patient, and we think as confidence comes back into public markets, and as there's more competition for these kind of assets, we think they get far closer to intrinsic value, and there's a long, long way to go. Looking deeper into that mid-cap sweet spot, I've spoken about ACI and Imperial, which aren't pure SA play stories. A company like the JSE is a conviction holding of ours. It has idiosyncratic features. It's a high-quality business. If we look into the infrastructure and contracting sector, we're seeing very good opportunity. If you arrived 10 years ago and you tendered for business to build a big road or big infrastructure project, you would have been tendering against in excess of 10 other competitors. You can see some of the companies that were listed then on the left-hand side. You can see the revenues that were being generated in 2011, and then you can compare that today. And if you went out there and you asked for tenders for, a big infrastructure or road project, effectively the only two listed SA companies that have the balance sheet and are participating in that work today in the form of WBHO and Raubex, and our clients own both. Similarly, the gaming and hospitality sector was devastated last year. The stocks got incredibly cheap. They will recover. They proved to be resilient, and our clients have exposure, and we added capital into this area during the course of last year. I'll move out of the mid-cap sector and turn to a large cap conviction holding in the PSG funds, and that's Discovery. Our clients have owned it for a long time. We've spoken about it in the past. We've spoken about the management team and the fact that they founder-led, aligned, and their track record. We've spoken about the global fintech opportunity and the benefits of the shared value model, so I'm not going to spend a lot of time on that today. But what I will talk briefly to is the upside potential in this business. It's fallen deeply out of favor. It's been hit by some factors over the last few years. And an interesting way to look at it is to say, let's look at 2020 earnings. And Discovery earned 6 billion rand in 2020. And then if we look at the body blows that they took in that period, and we reverse some of them, where do we end up? So they provided for mortality claims, COVID-related mortality claims, and the very low level of interest rates in the UK. That cost them more than 2 billion rand in those financial results. We view those as once-offs. We don't see that situation as being an every year occurrence. They also spent 2.2 billion rand on new business ventures. In other words, new business ventures that incurred losses. And the primary one there was the bank. So if we took the 2.1 billion of once-offs and the 2.2 billion of losses, and we assumed the losses effectively moved into break-even category, and then we took the balance of the Discovery business and we grew it at 9% per annum, which is pretty conservative. We believe we expected to blow that out of the water. And we grew those earnings to 2023. Where do we find ourselves? We think Discovery, under those circumstances, would earn 13 billion rand. If we applied the average rating that Discovery's attracted, and we think this is a high-quality business, and we think it should attract a premium rating, all of a sudden the stock is worth 230 rand a share, which is approximately double where it is today. Clearly not a trivial outcome for our clients. And we think very representative of the opportunity set that is available on the JSE at the moment. If you're prepared to look into areas that the market doesn't like and try and identify some of those winners of the future. Ladies and gentlemen, that's where we're going to leave it. I'm going to wrap up by just reminding you that we think it's appropriate to be very aware of some of these extreme conditions that we're currently witnessing and to be thinking about the potential impact on your portfolios. We have a view that it is very unlikely that the past winners will be the future winners. If we look into most portfolios out there, they're very heavily exposed to the past winners. We'll see. We think this is an excellent environment for differentiated, patient managers like ourselves. We think good things are going to happen. We think they're starting to happen, and the signs are encouraging. And most importantly, when we look into our portfolios, we look into the stocks that our clients own, we think returns look very, very healthy. I also, on the picture on the right is our latest angles and perspectives. It should come out either later today or early next week. I highly encourage you to get your hands on a copy. We go into these and a few other topics in a little bit more detail, and I think you'll find it a good read. At that point, I'd like to really thank you for joining us today. It's been a pleasure articulating our views. I wish you good fortune over the balance of the year. Stay safe, and thank you very much.